this cycle, the cycle that we're seeing right now, and what appears to be relatively low sensitivity to rising interest rates is actually a function of the almost 15 years of extraordinary monetary stimulation that we saw in the period before and during COVID. And so, what that allowed a lot of folks to do is basically refinance the debts that they have and extend the duration, refinance them into fixed borrowing
Hmm.
cost, extended in an extended duration. And so, for instance, if you're a household and you borrowed at a 2% mortgage in the United States, and short rates can be at 2%, they can be at 5%, or they could be at 10,000%, and it would have no impact on what your mortgage cost is, right? You say pay the same amount of your mortgage cost for the next 30 years. And of course that will influence incremental borrowing and incremental spending, but it doesn't have much immediate effect. In the same way, it used to be that corporations borrowed floating basically. And so when interest rates rose, they had to pay more debt service, which depressed their earnings. Well, today they basically if you're Apple, you basically borrowed at 2% for the next 30 years when times were good. And so companies are also not facing much of an impact of rising interest rates in the immediate sense. And so the result is we have an economy that actually, in order to create financial stability, in order to stimulate the economy, meaningfully reduced its sensitivity to interest rates. And the outcome of that is when you want to slow the economy, right, by tightening a fair amount, it's just been a lot harder to slow the economy because the economy is just much less sensitive to interest rate rises than it has been in past cycles.
Hmm. Yeah, except for it seems like tech, right? Like tech is very exposed to rising interest rates, the financial sector, but it seems like manufacturing, everyone else is pretty insulated.
Yeah, I mean, tech in particular, and this is where you want to sort of separate. There are companies and industries that are very reliant on incremental borrowing.
Hmm.
Now, as you raise interest rates, incremental borrowers do suffer consequences because they have to keep borrowing on an ongoing basis. So if you're a loss-making tech company, right, when huge amounts of money and liquidity were flowing, it was very easy to continue to borrow to finance your burn rate. And borrow could be directly borrow, or it could be, get equity financing and all the different ways that they were able to get access to capital. Okay, well, interest rates rise, and what happens is the ability to access incremental capital ends up, slowing down and becomes much more difficult. And so we've seen that in loss-making tech companies. The stocks are down 80%. The companies are starting to die. Employment in that area of the economy has started to slow. But the coastal finance people might think that venture businesses are like, the most important thing that's going on. But like, that's not the reality. Like, venture tech businesses employ like a very, very tiny fraction of the overall economy and the labor force. And so what really matters is like all the restaurants being run in Peoria and Columbus to what's going on with the labor force, much more so than the fact that, some venture funded tech companies are dying. It just doesn't matter that much in the scope of the overall economy. And the overall economy is driven by that overall borrowing situation that we just described, where there has been a big reduction in the sensitivity to interest rates.